Happy New Year. Welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, January 6, 2021. Investors took out about $8.5 billion out of the conventional fund business and ETF business as well for the first week in three. We saw outflows. There were some concerns out there. Obviously, people, were, just learning about the Georgia win. It had not been completed yet. The blue sweep, if you want to call it, or the blue wave for Democrats. So they took over the Senate. And so some people were really concerned that there's going to be more spending, maybe a little more inflation and the like. But that said, even though we had outflows, maybe because of that, we saw some really good returns in the market. We saw the kind of the rotation has been going on in December and the first part of January here now, where people are shunning, let's say, NASDAQ and S&P 500 and Dow, and going after out of favor value, small cap and the like. And in fact, we saw the Russell 2000 post a 3.49% return, and this is again Wednesday to Wednesday time periods that we're taking a look at, so it was very good. New Year's trading week, actually a lot of people just ignore it because it is usually very thin. But anyways, it was a fairly good week, and as far as returns go, we did see outflows. Well, let's see how those outflows actually panned out and how we actually got to where we're going here. Basically, you saw in our macro groups, equity funds handed back about $5.4 billion. Not a lot to write home about, but certainly net outflows. Taxable bond funds continue to take in money, $6 billion this week. Muni bond funds took in about 1.1, but we did see an exodus out of money market funds. That's been a continuation. We'll talk more about that a little bit later on. They saw about $10 billion, a little bit over $10.1 billion exit their coffers this week. So basically, what we'll do is we'll give kind of a play-by-play. This is something we've been doing in the past. I'm going to talk a little bit about estimated net flows into both conventional funds, and then I'll give you kind of a counter view by taking a look at what happened to ETFs as well. So let's start with our first macro group, go into detail on it, and talk about the equity fund flows for the week. Basically, what we saw was that equity funds had a positive return. Remember I told you the Russell 3000 was up 3.49. The Dow and S&P, everybody had positive returns basically. But the average equity fund was up 1% for the week. It's the 10th consecutive week they've seen plus side performance. And when we take a look at it, they've lost about $7.6 billion. Second consecutive week that they've actually seen outflows. We broke that 28-week or 30-week losing trend for 1 week late in December. But nonetheless, we saw about $7.6 billion in outflows. Domestic equity funds saw $4.9 billion flow out of their coffers. Second consecutive week they've seen outflows. They had a return of 0.91% on the plus side. It's the 10th consecutive week they saw plus side returns. So again, a little bit of head scratcher, but we've been seeing this for well over a year and a half now, people leaving conventional funds. And then we saw non-domestic equity funds lose about $2.7 billion. And again, we saw some performance changes where people are actually patting the coffers of emerging markets and the like, so that might change coming forward. Second consecutive week they've seen outflows as well, and they had a return of 1.19%. So again, 10th consecutive week they've seen plus side performance. So again, investors, and we'll see here in a second, ETFs did a little bit different, not a ton different. Again, it's just that shakiness at the end of the year. People aren't sure what's going to be going on, but how it broke out, large cap funds lost about $3.5 billion. That has been a trend I've been talking about for months and months and months on end. And then we saw small caps actually lose money. Remember I told you that's the Russell 2000 actually had the 3.49% return, yet the retail investor actually pulled money out of about a little bit over $1 billion. Now, on the world equity side, we saw international equity funds basically lose about $2.4 billion, and we saw global equity funds lose about $246 million. So that's how we got to the totals there. Well, now I'll go ahead and give you that contrast of conventional equity funds versus conventional ETFs. We did see for the fourth consecutive week actual inflows into the ETF business. About $2.1 billion went into the group. Again, it's fourth consecutive week they've taken in net new money. The iShares, surprise, surprise, iShares Russell 2000 ETF took in the largest amount, and that would have been equivalent to about $1.2 billion. And then what we saw was the Spider GLD, Spider Gold, actually taken 1.1. So there's that dichotomy. People are maybe a little bit confused on what they can do. There's a go towards the riskier asset, the Russell 2000 small cap group. But let's also pat the coffers of gold and find some safety. So Spider Gold Fund took in about 1.1. And at the bottom, though, kind of the favorites that were around, and again, they've been off and on, but Invesco QQQ Trust Fund handed back the largest amount, $2.7 billion. And then what we had was the Spider S&P 500 ETF, SPY, hand back about $2.2 billion. So again, a little bit of a dichotomy, but we have seen what I'm going to call at least a leaning towards rotation out of the stay-at-home stocks, the big tech stocks, and kind of going after those out of favor. We saw some value flows, we saw some safety flows into the GLD, as I just said. But certainly movements into smaller, more riskier type of stocks, and that was kind of the story there. Well, let's go ahead now and move our attention now towards the taxable bond fund side. So if we take a look at taxable bond funds, again, this is on the conventional fund side. We saw for the third consecutive week, they took in net new money, $6.4 billion this week. Second consecutive week, they've had plus side returns, this time to the tune of 0.19%. There is a little concern about inflation out there because, again, it wasn't ratified yet, but certainly looked like the blue wave had occurred, and that means that President-elect Joe Biden is more likely to be able to pass through his big spending plans, and of course that could be inflationary. That's what people were a little bit concerned about, but still, plus side returns 0.19%. Corporate investment grade debt funds took in the largest amount at $4.9 billion, and then what we saw was international and global funds take in about $507 million. And then on the bottom side, we saw balanced funds hand back $148 million. Now, I don't really like to have balance in the fixed income group because most balanced funds, if you think of it, at least 60-40, some of the more aggressive ones are maybe even up to 80% in equity. But that's where we have it in our legacy product here. So balanced funds were the big loser, $148 million. Not a lot to write home about on that one. Well, now let's turn our attention to the fixed income ETFs. And here's that dichotomy I was talking about a little bit. Basically we saw outflows. This is the third week in four that the fixed income ETF saw outflows, but only to a tune of about $436 million. Let's go ahead and take a peek at that slide when we take a look at it. We're basically just looking at the tops and the bottoms here, but basically the flows out of the fixed income ETFs were actually preceded by what I was talking about, a little bit of inflationary flows. So we saw the iShares TIP Bond Fund ETF taking about $265 million. Not a lot, but people are starting to become cautious. Invesco Senior Loan Fund ETF basically to about $205 million. So again, the kind of story of being conservative, looking at stuff that might benefit if there is a little bit of inflationary spike. I know that the Fed came out, I think it was the Chicago Fed, came out and said basically it's going to take years before inflation starts cooking through this economy. But nonetheless, people, again, took their foot off the pedal and maybe even tapped the brakes a little bit. On the downside, we saw the iShares iBox Dollar Investment Grade Corporate Bond Fund lose the most, $908 million, not a lot. And the iShares iBox Dollar High Yield Corporate Bond Fund handed back about $792 million for that group as well. So we did see a little bit of that, if you will, caution play with possible inflationary risks. That said, let's go ahead and move on to our Muni Bond Fund universe. And our Muni Bond Fund universe for the 9th consecutive week basically saw inflows. $899 million this week. Again, 9th consecutive week. We saw for the 11th consecutive week plus side returns, and it was 0.39%. And I know people go, what's 0.39? That's in a week. And it's for a muni bond fund, so it's actually pretty strong. What we saw was the short muni debt funds taking about $303 million. We saw general insured muni debt funds taking about $254 million. Every category in this group actually had plus side inflows. So on the conventional fund side. Now, if we take a look at the muni bond side on the ETFs, I don't usually have a slide for this. Maybe I'll start creating one in the future because it's getting a little bit more popular. We basically saw them take in a total of $243 million this week, and that is the 11th consecutive week that they have seen the net inflows on the positive side. So that was a little bit of the story on that side. Well, let's go ahead now and turn our attention to money market funds. And I told you that we saw outflows. It's the First week in 3, though, that we've actually seen net outflows. It's been off and on. We saw some big outflows towards the end of the year. People were just taking money hand over fist over it. And then we had a couple of weeks right at the end of the year where people were concerned about where the market was going, and they took money out. Well, they continued on for the first week in 3 for January, taking about $10.1 billion. Let's go ahead and take a peek at that slide and see what's going on there. Basically, first week in 3, $10.1 billion in outflow. How it broke out, though, take a look at taxable money market funds. We saw $11.9 billion in net outflows. However, it was very uneven. Institutional investors, and I say that with a little bit tongue-in-cheek, institutional funds often can be your or my 401k plans that our corporations have bought into and got really cheap expense ratios for us and that type of stuff. So institutional investors took out about $21.7 billion, while the retail accounts, and this could be our IRAs or even our individual accounts, took in about $9.8 billion. So we really saw a dichotomy there. The institutional money market funds lost about 21.7. Retail money market funds took in about 9.8. And then the story I was telling you about, certainly muni bond funds, people are still thinking about taxes. Tax guys coming up pretty soon, so people are still concerned about it. Maybe they'll lose interest. But $1.7 billion of net new money came into that group this this week. So that was a little bit of change as well. What we've been seeing is flows into munis and then flows out of money market funds. But in this case, we saw munis into both product classes. That is for sure. Well, that basically does it for me now. And we had some news. Obviously, I've talked about it already. The Georgia elections came out. There was 2 open spots. Basically, they made it so that there is an equal split in the Senate right now. So 50 and 50 on both sides, with basically Vice President-elect Kamala Harris basically being the tiebreaker. So a lot of what's going through, unless they can get some of the Democrats that are actually, there were some independents that were kind of caucusing with the Democrats, unless they can get them to do it, pretty much, I think Joe Biden's going to have a clean sweep to be able to take off. And with that said, what we heard yesterday, this is Saturday morning. Normally I record on Friday, on the day that day after I basically publish these reports, but year end was very busy this year. So anyways, we heard that 140,000 job losses occurred in December. That's the first job loss we've seen since April. So May, June, July have all been positive. We've seen those huge numbers. Obviously that big job loss was in the $20 billion or $20 million, 20 million person range. So it was a monster. But really taking a look at this and seeing $140,000 loss, I thought we might see some market hiccups there. And in fact, we didn't. There must be a ton of Keynesian economists out there that said, we know that Biden's going to, put some money in there. I think we may even have a third bailout, a third fiscal stimulus, and I think everybody's been expecting that as well with the president-elect winning. But I expected to see the market go down. Instead, we saw another new record closing highs out in the market. So we'll have to keep an eye on that as well, and certainly with the things that are going on, to see if people kind of say, job losses in December, kind of normal. I mean, we have people that were seasonal that get laid off. There wasn't a lot of seasonal hiring this year, but certainly there are some concerns out there, and I think people will start keeping eye on earnings as they come out, and forecasts, and then certainly on the economics as we move forward. And again, we'll have a keen eye on what's been happening in the Capitol. And with some of the, I'm going to say, whether it's fringe left or fringe right, causing great havoc, and people have obviously attributed to President Trump's near and dear followers the siege of the Capitol. But we'll keep an eye on how that happens and what happens in the last couple of weeks of his presidency, and certainly as we look forward to the inauguration of President-elect Joe Biden. Well, that's it for me. If I haven't done a deep enough dive for you, please go to our site at www.lipperusfundflows.com and take a deeper look. If not, join me next week when I'll tell you a little bit more about what's happening in the flows. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.